You see a stock crash. It pauses, turns green, and you think you have finally found the bottom. You buy in, only to watch the floor give out again. To stop catching falling knives, you need a reliable way to verify when a downtrend is actually over. That is where the complex head and shoulders bottom comes in. Before we break this down, open your charting software and locate your volume indicator. Turn it on. We are going to need it to verify this pattern. Mastering this specific multi-trough pattern removes the guesswork. It gives you clear entry signals and highly specific measurable profit targets. A standard head and shoulders bottom has 3 distinct troughs: a left shoulder, a lower head, and a right shoulder. The complex version expands on this structure by adding multiple shoulders, or sometimes multiple heads. Instead of a quick pivot, prices move sideways. You can identify a cluster of shoulders forming around the central head. The price tests the lowest level multiple times. These multiple low points create a stronger base of support than a single dip. If you are trading during a bear market, the data points to a specific edge. Prioritize patterns that look visually tall and narrow. They historically yield the best post-breakout performance when the broader market is down. Waiting for these extra troughs to form requires patience, but that patience keeps your capital safely on the sidelines while the actual market bottom is still trying to establish itself. This chart shows our next filter, visual symmetry. The right side of the pattern should mirror the left side in width, depth, and overall distance from the central head. This symmetry shows that buyers and sellers are locked in an organized, predictable tug-of-war. It signals that the chaotic downward momentum is neutralizing. Visual shape alone is not enough. We must check the volume, the ultimate lie detector for this pattern. You want heavier volume forming the left side, then steadily decreasing. Look at the volume on the right shoulder. It drops off significantly. This drop-off proves that sellers are exhausted. There is simply no one left willing to push the price lower, creating the exact condition required for a reversal to take hold. Now we draw our boundary, the neckline. Connect the highest price peaks directly between the shoulders and the head. Your mandatory entry trigger is waiting for a daily candle to close completely above that neckline, with a corresponding spike in volume directly below it. When price shatters that neckline ceiling with heavy volume, it forces short sellers to cover and pulls new buyers in, creating a massive upward surge. Warning tone. The most common mistake traders make is buying early because the pattern looks almost finished. Do not jump the gun. Until that neckline is definitively broken, the stock is still technically in a downtrend. A confirmed close above the line is the only safe entry signal. To secure profits, use the measure rule. Calculate the vertical distance from the head's lowest point straight up to the neckline. Add that measurement to your breakout price. That gives you your highly specific minimum target price to exit the trade. You also need a plan for when things go wrong. Here, the stock breaks the neckline, but volume is anemic and price slides backward. If price falls below the lowest point of the head, the pattern. To protect your capital from a sudden drop, place your stop loss just below the lowest right shoulder. This keeps you safe while allowing room for a normal, temporary pullback. Applying the measure rule for profits and a hard stop loss for risk removes emotion from the equation. You are executing a calculated strategy based on strict probabilities rather than guesswork. Let's review the 4 steps. Step 1, spot the multiple troughs. Step 2, verify visual symmetry and decreasing volume. Step 3, wait for a confirmed close above the neckline. And step 4, apply the measure rule to secure your profits. Now it is time to put this into practice. Open up your charting software, pull up your favorite stock, and scan the last year of price action to locate a valid, complex head and shoulders bottom. Once you find one, drop the ticker in the comments below. Let me know especially if you spot a tall and narrow formation forming right now in a bear market. Market volatility will always exist, but relying on data-driven confirmation keeps you profitable while everyone else is trading on emotion.